Hey, welcome back to the channel. I'm John Smith, and today we're going to talk about something every person trying to build wealth or protect their savings needs to understand. We're talking about gold versus silver. And before you think, okay, John, I've heard this 100 times, stick with me, because what I'm walking you through today is not just a surface-level comparison. We're going to dig into the history, the real-world economics, the psychology, and the actual investment logic behind both metals. By the end, you'll have a clear mental framework for thinking about both of them, not just which one sounds cooler, but which one actually makes sense for your situation and why. So let's start at the very beginning, because this is where a lot of people get it wrong. When people talk about gold and silver as investments, they often treat them like the same thing, two versions of the same trade. But they're actually quite different. They behave differently, they're used differently, they respond to different economic conditions, and the people buying them often have very different goals. Once you understand those differences at a deep level, everything else starts to click. Let's go back in time for a second. Thousands of years ago, both gold and silver were used as real physical money. Gold was rarer, harder to find, and used for large transactions. Kings paying armies, countries settling debts, merchants trading across continents. Silver was more common and became the everyday money, the currency of regular people. If you wanted to buy bread or pay for a service, silver was your go-to. Gold was kept in vaults. Silver circulated in pockets. That distinction, rare and reserved versus common and circulating, still tells us a lot about how these metals function today. Throughout all of human history, across every major civilization, gold and silver have maintained value. Empires have risen and fallen. Currencies have been created and destroyed. Economic systems have been completely overhauled. And yet gold and silver are still here, still considered valuable, still bought and sold and held by central banks, governments, and millions of investors worldwide. That's not a coincidence. That's thousands of years of human behavior telling us something important. So let's break this down. What exactly is gold? At its core, gold is what financial professionals call a store of value. It doesn't produce anything, doesn't pay a dividend, doesn't generate cash flow. But it holds purchasing power over time in a way that paper currency simply does not. Think about it this way. In ancient Rome, a soldier was paid a certain amount of gold that could buy a quality toga, sandals, and a good meal. Today, that same amount of gold in dollar terms can still buy you a decent suit, shoes, and dinner. The purchasing power held. Your dollar savings from 50 years ago? Not so much. That's the fundamental case for gold. It's not about getting rich quickly. It's about not getting poor slowly. Silver is a different story, and this is where it gets really interesting. Silver is also a store of value historically, absolutely, but silver has something gold doesn't have. Massive industrial demand. Roughly half of all silver consumed every year goes into industrial applications. We're talking solar panels, electric vehicles, electronics, medical equipment, water purification, and semiconductors. Every time you use your smartphone, there's silver in it. Every time energy is captured from sunlight by a solar panel, silver is part of that process. So silver isn't just sitting in a vault waiting to be an inflation hedge. It's actively being used, consumed, and in many cases permanently removed from circulation because it ends up inside products that are never recycled. Now this is important because it means silver has a dual nature that gold simply doesn't have. Gold is almost entirely a monetary metal. Its demand comes from investment, jewelry, and central bank reserves. Silver straddles the line between monetary metal and industrial commodity. That dual nature makes its price behavior very different from gold. Here's a question worth sitting with. If the global economy is booming, factories are running, technology is advancing, solar installations are growing, electric vehicles are being built at record rates, which metal benefits more? Silver. All of that economic activity drives industrial demand for silver, while gold's demand stays relatively stable. But flip the script. If the economy is struggling, inflation is rising, currencies are losing value, and people are scared. Which metal do they rush to? Gold. In times of fear and uncertainty, gold is the classic safe haven. Silver gets some attention too, but gold gets the bulk of it. This leads us to one of the most fascinating concepts in precious metals investing, the gold-to-silver ratio. Let me explain what this is because it's one of the most useful tools for thinking about these two metals. The ratio is simply the price of gold divided by the price of silver. It tells you how many ounces of silver it would take to buy 1 ounce of gold. Historically, in nature, gold and silver occur in the Earth's crust at roughly a 1:9 ratio. But the market price ratio has been all over the map. In the Roman Empire, it was around 12:1. For much of the 20th century, it hovered near 47:1. In recent years, that ratio has gone as high as 120:1 and as low as the 60s during certain market conditions. When the ratio is very high, say 80, 90, or above, silver is historically cheap relative to gold. When the ratio is low, in the 40s or 50s, silver is historically expensive relative to gold. Investors who follow this ratio use it as a rough guide for which metal offers more relative value at a given moment. It's not a perfect predictor, but it's a genuinely useful mental model. Now let me talk about accessibility, because this is underrated in this conversation. Gold is expensive per ounce. Depending on when you're watching this, we're talking well over $1,000 for a single ounce. Getting started with physical gold requires a meaningful upfront investment. Silver, on the other hand, is far more accessible. You can walk into a coin shop or go online and buy a single 1-ounce silver coin for a fraction of that. That matters for people just starting out, or those who want to add precious metals to their portfolio without committing a large sum at once. Silver is the people's metal in terms of accessibility, and historically that's exactly what it was designed to be. Because silver is cheaper per ounce, it's also more practical in a certain real-world sense. If you ever needed to use a precious metal for barter in some extreme disruption scenario, a 1-ounce silver coin is a lot more practical than a 1-ounce gold coin. Gold is so valuable that making change becomes a problem. Silver's lower price per unit makes it usable in everyday-sized transactions. I'm not saying we're heading for a barter economy. I'm not that kind of person. But it's worth understanding the practical difference in how these metals function as physical assets. All right, let's talk about volatility, because this is where new investors often get caught off guard. Gold is volatile. It moves, and its price can swing meaningfully in short periods. But silver is significantly more volatile than gold. We're talking 2, 3, sometimes 4 times the percentage price swings. When precious metals go up, silver often rises more, faster and higher. When metals sell off, silver often falls harder and faster. This is something you need to understand going in, not as a reason to avoid silver, but as a reason to have realistic expectations. Think about it this way. Imagine you're on open water. Gold is like a large cruise ship. It moves with the waves, but slowly and steadily. Silver is like a speedboat, nimble, capable of moving much faster, but tossed around more by the same waves. Neither is better or worse. They're just different. And depending on your personality, timeline, and financial situation, one might be more appropriate than the other. Hey, real quick, if you're getting value from this video, hit that like button. It genuinely helps this channel grow and lets me keep making content like this. And if you haven't subscribed yet, consider joining us. We talk about real financial topics in plain English. No hype, no gimmicks. All right, back to it. Let's talk about what's driving these metals in the broader economic environment. For several decades now, we've been in a world of expanding money supply. Central banks around the world have created enormous amounts of currency. And when more money is created, each unit of that money buys less over time. That's inflation. Inflation is one of the biggest drivers of precious metals demand. When people feel their paper money is losing value, they look for assets that hold value. Gold and silver have historically been two of the primary answers to that concern. The relationship between precious metals and inflation isn't perfectly mechanical on a month-to-month basis, but over longer periods, years and decades, gold has a strong track record of maintaining purchasing power during inflationary environments. Silver has a similar record, though it's murkier, because industrial demand pulls its price in different directions depending on economic cycles. Interest rates also play a major role, and I want to explain this clearly. Gold doesn't pay interest or dividends. So when rates are high, when you can earn 4 or 5% sitting in a treasury bond, gold becomes less attractive by comparison. Why hold something that pays nothing when safe alternatives pay meaningful interest? That logic tends to push gold prices down or hold them flat when rates are high. Conversely, when real interest rates are negative, meaning the rate after inflation is actually negative, gold becomes much more attractive because even a zero-return asset looks good compared to something losing you money in real terms. Silver follows similar logic with the added factor that industrial demand can sometimes override this dynamic entirely. Let me give you a concrete example of how differently these metals can behave. During the financial turmoil of 2008 and the early pandemic in 2020, gold held up remarkably well. Even as stock markets crashed and panic spread, gold maintained much of its value and in some cases rose. Why? Because scared money runs to gold. It's the classic flight to safety trade. Silver, in those same moments, actually dropped sharply because fear of an economic slowdown crushed industrial demand projections, and that component weighed heavily on silver's price. But then, and this is the key, once the initial shock passed, once governments pumped money into the economy and recovery narratives formed, silver absolutely exploded. In the summer of 2020, silver went on one of the most dramatic runs of any major asset class in decades, nearly doubling in price in a matter of weeks. Gold rose too, but silver blew past it in percentage terms. This is what people mean when they say silver has more upside in a precious metals bull market. It catches up fast and often overshoots. That's the speedboat effect in action. Now, let's talk about storage and practicality, a real-world consideration that often gets overlooked. Physical gold is incredibly dense. 1 ounce is roughly the size of a small sugar cube, and yet it's worth over $1,000. You can store significant wealth in a very small space. Silver is the opposite. Because it's worth so much less per ounce, storing the same dollar value requires dramatically more space and weight. $100,000 in silver at today's prices weighs hundreds of pounds and takes up serious physical room. That's a real logistical consideration that gold doesn't have. Both metals can also be accessed through paper instruments, ETFs, futures contracts, mining stocks, and streaming companies, giving you price exposure without taking physical possession. This approach is more convenient and easier to manage in a standard brokerage account. The trade-off is counterparty risk for people drawn to gold and silver precisely because they distrust paper assets and financial institutions. This defeats part of the purpose. It's a genuine tension every precious metals investor has to think through for themselves. Let me also touch on mining stocks briefly. Rather than buying the metal itself, you can buy shares in companies that mine gold or silver. These offer leveraged exposure to the metal. If gold rises 15% and a miner's production costs stay flat, their profits might jump 30 or 40% because every dollar above cost is pure profit, and that margin expands as prices rise. Mining stocks can therefore outperform the metal itself in a bull market, but they carry company-specific risks, management decisions, labor disputes, geopolitical issues at mine sites, cost overruns, and environmental regulations. More upside potential, but more downside risk as well. Now, let's talk about risk honestly, because any responsible discussion of investing has to include this. Gold can sit flat for years at a time. There was roughly a 20-year stretch from the early 1980s to the early 2000s where gold essentially went nowhere or declined. 2 decades of holding an asset that paid no income and didn't appreciate. If you'd put that same money into stocks or real estate during that period, you'd have done dramatically better. Opportunity cost is a real risk with gold, one that's easy to forget when prices are rising. Silver has all the same risks, amplified by volatility. 50% drops from peak to trough are not unusual in silver's history. 80% drawdowns have happened. If you're not prepared for that kind of swing emotionally and financially, silver can be a genuinely difficult asset to hold through rough periods. The investors who tend to do well in silver are either active traders with real discipline or long-term holders with genuine conviction who can sit through pain without panic selling at the bottom. There is also the issue of premiums when buying physical metals. When you buy a gold or silver coin or bar from a dealer, you don't just pay the spot price. You pay spot plus a premium covering the dealer's costs, minting, and their margin. For gold, premiums are typically a few percent above spot. For silver, they can be much higher, 10, 15, 20% or more in periods of high demand or low supply. That means silver needs to appreciate by that premium amount just for you to break even, not a deal breaker, but something every physical silver buyer needs to factor in from the start. So how do you actually think about all of this? Here's the mental framework I'd suggest. First, ask yourself why you're interested in precious metals at all. Is it primarily as insurance against inflation and currency debasement? Gold is the cleaner, more established, more liquid answer to that question. Is it because you believe in the green energy transition and silver's industrial demand story playing out over the next decade? Then silver might deserve a real place in your thinking. Is it because you want broad exposure to precious metals as a general hedge? Then maybe the answer is both, in proportions that fit your risk tolerance. Second, think about your time horizon. Long-term, 10, 15, 20 years, both metals have solid track records of preserving purchasing power. Shorter term, silver's volatility demands more caution and more active attention. Third, think honestly about how much volatility you can actually stomach, not theoretically but in practice. How do you feel when you watch something you own drop 20% in a month? If that's going to cause panic decisions, large silver positions may not be right for you. There's no shame in that answer. Self-awareness is a financial superpower. Fourth, think about position sizing. Neither gold nor silver is meant to be your entire portfolio. Most thoughtful approaches suggest precious metals allocations somewhere in the 5 to 15% range of a total portfolio, with the rest in a diversified mix of other assets. These metals are one tool in a larger toolkit, not a replacement for a balanced investment approach. As a student of markets and economic history, I find it hard to ignore that we're living through a period of extraordinary monetary expansion, geopolitical tension, and structural economic change. The demand for silver from the green energy transition alone represents one of the biggest shifts in industrial metals demand in decades, and central bank appetite for gold, particularly from banks outside the Western world, actively reducing dollar dependence, has been at historically elevated levels in recent years. These are structural, multi-decade forces. That doesn't tell you what to do tomorrow, but it does suggest that both metals are operating in an environment where their long-term thesis has real fundamental support. Let me bring this all together because I want you to walk away with a clear, useful picture in your head. Gold is the purer safe haven asset, less volatile, more liquid, more reliable in times of financial stress, and laser-focused on inflation protection and wealth preservation. Silver is the more dynamic, more volatile, more industrial of the two, with greater upside potential in precious metals bull markets, real demand driven by economic growth, and much better accessibility for smaller investors. But it comes with significantly more price swings and more complexity. The gold-to-silver ratio is a useful tool for thinking about relative value. Storage and practicality favor gold for large positions. Upside potential in bull markets and accessibility favor silver. Mining stocks give leveraged exposure to both but add business-level risk. Physical metals give you tangible ownership but require thoughtful planning around storage and insurance. Most importantly, neither one is a get-rich-quick strategy. Neither pays you income while you hold it. Both require patience, clear thinking, and realistic expectations. They're meant to complement a well-rounded portfolio, not replace one, serving as a hedge against the kinds of risks that traditional financial assets don't address as effectively: inflation, currency debasement, and systemic financial instability. If you're new to all of this, My honest suggestion is to start by learning before you spend. Read, watch, think. Understand why you want exposure to precious metals before deciding how much and in what form. When you do decide to get involved, start small. Get comfortable with how these markets move before committing a significant portion of your savings. I hope this video gave you a real, honest picture of what gold and silver are, how they differ, and how to think about them clearly. If it did, please give it a like. It helps this channel reach more people who could benefit from this kind of content. Drop a comment and let me know which metal you find more interesting or what topics you'd like me to cover next. I read every single comment, and your questions often shape future videos. I'm John Smith. This is the John Smith 02 channel, and I'll see you in the next one.